Hello and welcome to the day ahead. It is March the 28th. I'm David Scott. Let's turn to the action in global markets over the course on Friday, and Wall Street grinded higher and ended the session mixed. The S&P was led by financials, boosted by rising Treasury yields, which sent tech and other big growth names lower, taking the Nasdaq down for the session. Now the yield on a 10-year Treasury note rose above 2.5% to a near 3-year peak. Markets are now pricing in a more aggressive Fed, with Bank of America joining its peers calling for 2 hikes of 50 basis points each at the June and July meeting for the Fed. Citi sees 50 pips at May, June, July and September of this year. Looking ahead, investors remain on edge amid mixed messaging on any progress in Ukraine-Russia talks.
We will have a different future, a brighter future, rooted in democracy and principle, hope and light, of decency and dignity, of freedom and possibilities. For God's sake, this man cannot remain in power.
Top US officials swooped in to clarify those comments, with Secretary of State Antony Blinken saying the Biden administration was not seeking to overthrow Russian President Vladimir Putin, but rather meant he cannot be empowered to wage war. Well, the focus this week remains again on the Ukraine conflict. Russian and Ukrainian negotiators will hold their next face-to-face meeting in Istanbul, the Turkish president's office confirmed yesterday. The Turkish president continues to urge his Russian counterpart to accept a ceasefire as soon as possible. It comes as Ukraine President Volodymyr Zelensky says he is prepared to discuss adopting a neutral status as part of a peace deal with Russia, but it would have to be guaranteed by third parties and put to a referendum. On the data docket, markets will be watching closely for key non-farm payrolls release on Friday at the end of the week. Markets are expecting some 450,000 jobs to be added for the month of March. That's compared to 678,000 in February, with the unemployment rate tipped to fall further to 3.7%. That's down from 3.8% currently. And on the corporate dial, Chewy, Lululemon, BioNTech and Walgreens Boots Alliance all reporting earnings. And turning to the bigger picture now, and the greenback continues to track high for its 6th week in 7 as oil reversed earlier weakness after a missile attack hit Saudi Arabia's state-run oil company Aramco's storage facility. This, as further data stateside, continues to point to rising prices. Sticking in that energy space, and after a late-night talks in Brussels Friday night, the EU and US unveiled a deal to supply Europe with more US liquefied natural gas, as leaders of the bloc look to curb their reliance on Russian fossil fuels. The euro also pared back earlier gains, on pace for its 6th weekly decline in 7, though comments from ECB President Christine Lagarde saying she doesn't expect the war in Ukraine to push into the eurozone into stagflation kept the currency in a tight range for the session. The yen bounced back marginally from a 6-week low, though remains under pressure as the Bank of Japan is expected to keep its soft monetary policy in place. Cable, meanwhile, traded relatively flat for the session. And in China, industrial profits grew at a faster pace in January and February, signaling some momentum returning to the economic recovery, though the outlook remains clouded by the conflict in Ukraine and COVID outbreaks domestically. And finally, in crypto, Bitcoin higher by over 1% to kiss the $44,500 US dollar mark. And bringing it all back home now, and SPY futures are pointing to a positive start to this Monday trading session, up around 0.4% or 33 points. Base metals were lower, led by a slide in nickel. Gold also fell, remaining below that $2,000 US dollar an ounce level. We'll be keeping a close eye on iron ore, with futures nearly 1% higher to end the week, with ADRs for BHP and Rio up 1.4% and 1.6% respectively. And let's get a quick check on what we're watching here at home in the week ahead. And it's all about the federal budget handed down tomorrow on Tuesday, with forecast for a better than expected deficit ranging between $70 and $80 billion, and a cash splash to help continue to rebuild the economy after a COVID-induced slumber. Now, worries for the market, though, are firmly fixed on inflation and the economic recovery, with analysts making striking comparisons to what we saw in the 1970s and how central banks should react to the two-pronged problem of rising inflation and stagnant economic growth.
People, businesses, workers adjust their inflation expectations higher, and you end up with that sort of 1970s style wage price inflation. Because don't forget, the 1970s was a big part of a supply shock particularly in commodities, obviously associated with oil and other things. So there are parallels with the 1970s.
This as Federal Treasurer Josh Frydenberg moved to calm fears over rising price pressures, all but confirming the Morrison government will cut the fuel excise as prices at the pump hit 8-year highs. However, the amount and duration of the cut are yet to be unveiled by the government. On the data docket, retail trade and weekly consumer confidence from ANZ Roy Morgan will be released on Tuesday, with private sector credit, building approvals and job vacancies for February on Thursday, along with a CoreLogic Home Value Index on Friday. Well, that does it for the day ahead. I'm David Scott, and I'll see you tomorrow.